taxes don't stop in retirement. In fact, for many retirees, taxes become more complicated rather than simpler. Income may come from several different sources, including Social Security, pensions, retirement accounts, and investments. While each source may seem manageable on its own, together they can create unexpected tax consequences if not understood properly. Many retirees assume that once they stop working, taxes will naturally decrease. While that can be true for some, it is not guaranteed. In some cases, retirees actually find themselves paying more in taxes than expected. This often happens not because of mistakes, but because certain IRS rules are not well understood. In this video, we'll walk through several IRS rules that retirees often overlook. These rules are not hidden, but they are easy to miss if you're not actively looking for them. Understanding how they work can help you avoid surprises, manage your income more effectively, and keep more of what you've earned throughout your working years. One of the most misunderstood areas of retirement taxation involves Social Security benefits. Many retirees are surprised to learn that Social Security can be taxable. Depending on your total income, up to 85% of your Social Security benefits may be subject to federal income tax. This includes income from pensions, wages, interest, dividends, and withdrawals from retirement accounts. The IRS uses a formula called combined income to determine whether your Social Security benefits are taxable. This calculation is not always intuitive, and many retirees cross the threshold without realizing it. As income increases over time due to cost of living adjustments or required withdrawals, more of Social Security may become taxable. Another commonly overlooked rule involves required minimum distributions, often referred to as RMDs. Once you reach a certain age, the IRS requires you to withdraw a minimum amount each year from certain retirement accounts. These withdrawals are generally taxable as ordinary income. Failing to take an RMD on time can result in significant penalties. While recent changes have reduced these penalties, they are still substantial. Many retirees miss RMD deadlines simply because they are unaware of the requirement or unsure which accounts are affected. RMDs can also push retirees into higher tax brackets unexpectedly. A large required withdrawal, combined with other income sources, can increase overall tax liability. This is especially true for retirees who have accumulated significant savings in tax-deferred accounts. Another IRS rule that surprises many retirees involves capital gains taxes. Selling investments, property, or other assets can trigger capital gains taxes, even in retirement. While long-term capital gains are taxed differently than ordinary income, they can still affect your overall tax picture. Capital gains can also interact with other tax rules. For example, a large capital gain can increase your combined income, potentially making more of your Social Security taxable or triggering higher Medicare premiums. Understanding how these pieces fit together is important for managing tax exposure. Medicare premiums themselves are another area influenced by IRS-related rules. Medicare Part B and Part D premiums can increase based on income levels reported on tax returns from previous years. These income-related adjustments are often unexpected and can reduce monthly retirement income. These premium increases are based on modified adjusted gross income, which includes various income sources. Retirees may be surprised when a one-time income event, such as selling a property or taking a large distribution, affects Medicare premiums later. Another overlooked rule involves the taxation of pensions and annuities. Some pension income may be fully taxable, partially taxable, or not taxable at all, depending on how contributions were made. Misunderstanding how pension income is taxed can lead to incorrect withholding or underpayment of taxes. State taxes add another layer of complexity. Some states tax retirement income differently than others. Retirees who move or split time between states may find themselves subject to different tax rules than expected. Understanding state-level taxation is just as important as federal rules. Tax withholding is another area retirees often overlook. Unlike wages, retirement income does not always have taxes withheld automatically. If withholding is too low, retirees may face unexpected tax bills or underpayment penalties. Adjusting withholding or making estimated payments can help avoid this issue. Another important IRS rule involves charitable giving. While charitable contributions can provide tax benefits, recent changes have altered how deductions work. Many retirees assume charitable donations automatically reduce taxes, but the rules depend on how deductions are claimed. Qualified charitable distributions, or QCDs, are another option available to certain retirees. These allow eligible individuals to donate directly from retirement accounts to qualified charities, potentially reducing taxable income. However, eligibility rules and limits apply. Healthcare expenses can also affect taxes. Some medical expenses may be deductible if they exceed a certain percentage of income. While not everyone qualifies, understanding these thresholds can help retirees track expenses more effectively. Another area that causes confusion is filing status. Changes in marital status, such as the loss of a spouse, can affect tax brackets and deductions. Retirees who experience life changes may need to adjust their tax planning accordingly. Tax credits and deductions for seniors exist, but they are not always automatic. Eligibility may depend on income levels, age, or other factors. Being aware of these provisions can help retirees avoid missing potential benefits. Technology has changed how taxes are filed and managed. Online filing, digital records, and electronic payments are now common. While this can be convenient, it also increases the importance of understanding official IRS communication and avoiding scams. IRS letters and notices can cause anxiety, but not all notices indicate a problem. Some are informational or request clarification. Understanding how to read and respond to IRS correspondence calmly can prevent unnecessary stress. Another overlooked issue involves timing. The timing of income, deductions, and withdrawals can affect taxes significantly. Spreading income over multiple years rather than taking large amounts at once may help manage tax brackets more effectively. Tax planning in retirement is not about avoiding taxes entirely. It's about understanding the rules and making informed decisions within them. Small adjustments can sometimes make a meaningful difference over time. Many retirees assume tax planning is only for the wealthy, but that's not true. Anyone with multiple income sources can benefit from basic tax awareness. Understanding how IRS rules apply to your situation helps you maintain control and avoid surprises. It's also important to review tax situations regularly. Tax laws change and personal circumstances evolve. What worked one year may not work the next. Periodic review helps keep plans aligned with current rules. Retirement should be a time of stability and confidence. Taxes are a part of that picture, whether we like it or not. Understanding IRS rules that commonly affect retirees allows you to plan calmly rather than react under pressure. Knowledge reduces anxiety. When you understand why taxes work the way they do, you're better equipped to make thoughtful decisions. Awareness doesn't require expertise, just attention and preparation. As always, individual situations vary. General information can provide guidance, but personal advice should come from qualified professionals who understand your specific circumstances. Understanding IRS rules in retirement isn't about fear or complexity. It's about clarity. With the right information, retirees can manage taxes more confidently and protect more of their retirement income.